Accounting. According to the American Institute of Chartered Public Accounting says that accounting is the art of recording, classifying and summarizing in a significant manner and in the term of money or money's worth transaction and event. It means that if you look at the organization, the money and money worth transaction daily happen. Those transactions should be recorded and classified. Based on the classification, then we have to be summarized. There are several parties looking for the organization. For an example, I can say that the owners, he invests the money to the organization, so he expecting profit. And the second one, the employers and employees. So employees, they need to be get the salary every month. So likewise, the managers and government, they are looking for the organization. So the accounting is really important to get the information, and we have to be summarize, recording, classifying and summarizing based on the world concept of the accounting. Then we have to get that the meaningful message, and we can deliver the relevant parties. Accounting is the language of business. It really, the accounting is the language of business. For an example, if you take the financial position or balance sheet, we can understand how the company invest or what are the position of the company current situation. As well, if you look at that financial statement or income statement, you can understand how the profit and how they generate their operational activities. So based on the financial statement, we can get that meaningful information relevant with the company's activities. So that's why the accounting is the language of business. For an example, I'm going to click this one. You can see the financial position of, this is the financial statement, income statement if one of the company. So you can look at this one. Here is 2012. The transaction is increased. If you look at the 2012, 100% of net financial income, but 2013 it's increased by 126.3%. So likewise, if you look at the final one, this is the 2012, the profit of the company, but the 2013 it's a loss. So if you analyze each and segment of the financial statement, especially income statement and the balance sheet, you can understand we need to be invest or not, and we can take an important decision based on the financial statement. So that's what we are calling that the accounting is the one of the business language. Then we are going to study about the accounts types. There are 5 types of accounts. The first one, revenue, then expenses, then asset, liabilities and capital. So these are the main accounts type, and we are going to look one by one. Revenue. What is the revenue? The revenue is the amount which as a result of operation is added to the capital. It means that the operational activities, we get the finally some amount, so that is called that the revenue. For an example, I have a bookshop, I sell the goods, I sell the books, So the final thing is I sell the books and get the money. So that is the result of operation. Likewise, if I have a dealers, I can sell my books to the dealers and I can get the commission and brokerage fees, and if they delay the payment I can get the interest. So these are the things are relevant with the operational activities. So those are the things called the revenue. What are the things getting from the operational activities? That's called the revenue, and it will add it into the capital. For an example, we can say that sales is a one of the revenue, received interest, received the commission, and received brokerage, etc. So this is the revenue. And also the revenue, it's increased the owner's equity. Why? Because if we sell the product, we sell the cost of goods plus profit. The profit, it's relevant with the owner's equity. So that's what. And now we are going to look at that. What is the expenses? Expenses mean the amount incurred in the process of earning revenue. It means that what are the activities participate for the process of earning revenue. Those are the costs are called the expenses. For an example, I have a bookshop and I need to sell the books, so I need to be rent the car, or I need to be build the one platform, and I need to be get the connection of telephone, and I need to be pay the electricity, and I need to pay the salary to the employees. These are the things happen because of earning revenue. Because of selling the goods, I need to be support. These are the expenses. So those are the things are called that expenses. The process of earning revenue, what are the costs that occur, those are the things that we call the expenses. You can say the rent, telephone, electricity, salary, and insurance. If we insure our company, so we have to be pay, and also sometime we have to pay that interest. So those are the things are called that expenses. And then we are going to move to that the third type of accounts, that's called asset. What is the asset? Asset is a property of the value owned by a business. It means that what are the things are belongs with the business, so that is called assets. For an example, as I mentioned that previous example, I have a bookshop, so I bought a car, so the car is belongs to our business, so the car is our asset. And I buy the building, so the building belongs to the business, so the building is one of the asset. So that is the thing. And sometimes the asset physical or intangible. For an example, building we can see, right, as well the car we can see, and sometimes we buy the land we can see, but some of things are we cannot see. For an example, goodwill. The goodwill, it means that if some of the organization, if we tell the name is very popular in the area, so this is one of the assets in accounting, so it is called that goodwill. So those are the things are called asset. I have given a lot of example for the asset. Money, accounts receivable, it means that receivable from the debtors, machineries, buildings, inventories, goodwill, and royalty. So those are the things, the asset. An asset, we are going to divide it two categories: current asset and fixed asset. So what is the current asset, fixed asset? We are going to discuss in the next slide. Current asset mean it is normally we can say that within 1 year we can turn back to the cash. It means that if we have an asset, we can get the money within 1 year. So those are the assets are called current asset. For an example, we can say saving account. If we have the saving account, we can go to the bank and get the cash within 1 year. The maturity within 1 year. 1 year we can get the money back. If we have some financial document or financial things, within 1 year we can get back the cash. Those are the assets that are called the current asset. So second one is marketable security, stock, bonds. So those are the things also called the current asset. And account receivable, and it means that debtors, we need to collect the money from the debtors, so that's also one of the current assets. And inventories, if we have the inventories or stocks, so those stocks are we can get the money within 1 year, right? So that's also one of the current asset. And also prepaid expenses, if we have expenses but we have to give the advance expenses, so those money also we can get back within 1 year. So very short time, and within 1 year we can get back the money and we can turn to back to money. Those are the assets are called the current asset. And the next one, the fixed asset. Fixed asset mean it's more than 1 year. It's long lived resources. We commonly say that with long lived resources, within 1 year we cannot get back the asset. It take more than 1 year. So for an example, we can say buildings, land, equipment, furniture. We can't easily to sell the building. It's take a long time, as well land, the equipment. So those are the things are called the fixed asset. Now we are going to look at that. What is liability? Liability is a legal obligation of a business need to pay a debt. It means that a business or organization need to pay a debt. So those are the things are called the liabilities. For an example, the organization get the money from the bank loan, so we have to settle. And then sometimes we get the audit from the bank, we have to settle. And sometimes we didn't pay the money to the employee salary, so we have to settle or we have to pay. So those are the things are called the liabilities. This is two type. The first one, long term liabilities or non-current liabilities. The second one is a current liabilities. Now we are going to look at that long term liabilities or non-current liabilities. Non-current liabilities, it means that the maturity is more than 1 year. It means that more than 1 year we can settle small like that, right? So the long term liabilities obligation that will due for a long period of time. The due be will settle more than 1 year, right? So for an example, 5 years bank loan, so we have to be settled 5 years, not 1 year, 5 years. So first years we have to settle of sum of money, and the second years another money, like that. And then second example, 2 years debt. So 2 years mean it's more than 1 year, so that's what we call the non-current liabilities. So we have to settle. So those are the more than 1 year's debt, we call that non-current liabilities. And other one is current liabilities. Current liabilities mean it is we need to settle within 1 year, right? So the current liabilities are liabilities that are due within a short period of time. It will be within 1 year need to pay. Within 1 year we should settle the money. So those are the liabilities. Those are the debt, we call that liabilities. It's a current liability. For an example, account payable, salary payable, or rent we should pay within 1 year, and the electricity we should pay within 1 year, something like that. It is current liabilities. Then capital. What is the capital? Capital is a call the net worth. It's a company owner's net worth, same time it will be called the owner's capital. For an example, it means that who are start their business, right? For an example, I have a bookshop, I will invest the money 500,000. So this 500,000 is called the capital. It is the starting money or owner's capital, right? For an example, otherwise we can say I and my friend start a business 500,000. So these are 500,000 are called the capital. The owner's investment or owner's, what are the things that he put into the business, so those are the things called the owner's capital. They give the example, Ramu start a business to put 500,000. Now we are going to discuss about the accounting equation. If a company starting position, assets equals to liabilities plus capital. We have already studied 5 types of account. If the company start the beginning position, the asset equals to liabilities plus capital. After that, the equation will be changed. Asset equals to liabilities plus capital plus income minus expenses, because after 1 year the income and expenses occur in the organization. So that's what the accounting equation, it will be changed, that asset equals to liabilities plus capital plus income minus expenses. And if we can divide it in the assets, current asset and non-current asset or fixed asset, and liabilities we can divide it current liability, non-current liabilities likewise. So we can change our accounting equation like this: current asset plus fixed asset equals to long-term liabilities plus current liabilities plus capital plus income minus expenses. So this is the basic accounting equation. So now we are going to look at that accounts type with increase and decrease, what will happen in the equation sign. So if the asset increase, it will increase the debit, it's called the debit. If the liability increase, it's called credit, it means that the credit value increase. And then the capital increase, it's called the credit, increase the credit. And then income increase, it's a credit side increase, and expenses increase is a debit increase. Then the decrease value is opposite, credit debit 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 credit. Now we are going to look at that methods of accounting entry system. There are 2 types of accounting entry system: single entry system and double entry system. What is a single entry system? Single entry system means it is incompleted system, and the company just maintain cash, personals of debtors and creditors into the book. That's it. So that's a single entry system. Double entry system means debits always equals to credit. It means that an accounting system that records effect transaction and other event in at least 2 accounts with equal debit and credit. The debit amount and credit amount should be equal. If you look at that Tally softwares, we have to be enter the data or transaction based on the double entry system. If we put that the transaction, the Tally software generate the double entry system, then it will give us the trial balance and financial accounts. The step for the double entry system: first we have to prepare the journal, then ledger. After that, the Tally software will be create the trial balance and financial accounts and relevant things.